Good morning. It's Thursday, the 16th of January, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming like always from Mumbai, India's financial capital. Our top stories and themes. The stock markets hold up as a recovery sets in. Gold prices are inching up elsewhere in the world. Will India follow? The rupee's best performance in 7 months. Oil markets are still on the edge following sanctions on Russia, and British Petroleum, or now BP, steps up in Iraq. Indian promoters may not get the salary hikes they do if small shareholders had greater say. And how a liberal tax policy could help boost manufacturing.
This is the Core Report with Govindraj Ethiraj.
Indian markets hold a recovery and action on Wall Street. It was yet another day of breathless action in the stock markets, only because most market participants were holding their breath to see whether the benchmark indices would hold their recovery that we saw on Tuesday. Turned out they did, closing in positive territory for the second consecutive session on Wednesday. The 30-stock Sensex was up 224 points to close at 76,724, while the NSE Nifty 50 was up 37 points to close at 23,213. The fear index, which gauges volatility in the markets, ended a little higher. That's 1.3% at 15.26. Now, that's not something we track usually unless the markets are moving wildly, but worth noting once in a way. The Nifty, if you remember, had hit a 7-month low on Monday, which was the lowest point in the current wave of correction. Back on Wednesday, the Nifty Mid-Cap 100 and Nifty Small-Cap 100 were up slightly with gains of about 0.4 and 0.5%. Foreign institutional investors are still skittish about India. They've pulled out about $4 billion from both stocks and bonds so far in January 2025, adding to about $11 billion of outflows in the previous quarter, which is obviously a reversal from the $30 billion worth of buying seen between Jan and September 2024, according to Reuters computations. September is when the peak was hit and the markets started going down after that. Now, on Wall Street, US stock markets were up quite sharply on Wednesday overnight. The consumer price index, which everyone was waiting for, increased 0.4 on the month, putting the 12-month inflation rate at 2.9%, according to the Bureau of Labor Statistics. Economists surveyed by Dow Jones had been looking for a 0.3% increase and 2.9%. Much of the move higher in the consumer price index came from a 2.6% gain in energy prices for the month, and that in turn was pushed up by about a 4.5% surge in gasoline prices. Now, US inflation picked up last month as gas prices did rise sharply, though price gains for other goods were more muted. All of this is from CNBC. Now, earnings season in the US is also in full swing with good results from several of the biggest names in US finance, and inflation data is adding to the market optimism, says the Wall Street Journal. Profit at Goldman Sachs has more than doubled. JP Morgan and Wells Fargo also posted strong forecast-beating profit rises for last quarter. Citibank also swung to a profit, and per-share earnings beat consensus expectations, according to Wall Street Journal again. So the other big theme was inflation, and the consumer price index, as we said, showed prices rising 2.9% in the last 12 months, matching forecasts, and core prices were up by a slower than feared 3.2%. So bonds and stocks have rallied, and the dollar has become weak. Gold prices up. Gold prices were up on Wednesday as the US dollar and treasury yields fell back somewhat, while markets stood by for the US inflation data that we were talking about just now to get potential insights on the Federal Reserve's interest rate strategy. Spot gold was up at $2,683 per ounce, according to Reuters. The index, or rather the dollar index easing, has made bullion more attractive for other currency holders. The rupee jumps. The Indian rupee jumped on Wednesday after falling to a lifetime low in the prior session, that's on Tuesday, to log its best day in over 7 months. It was helped, among other things, by a softer dollar, which should become softer now going forward, or at least slightly. The rupee closed at 86 rupees 36 paise against the dollar, up slightly on Wednesday, its biggest single-day percentage gain since June 3rd, 2024, according to Reuters. It had earlier declined to an all-time low of 86 rupees 64 paise in the previous session. I'm sure you've been watching or following some of the discussions on whether or how much we should manage the exchange rate. That's from an Indian perspective. The dollar had earlier hit a 2-year high, and the rupee itself has weakened around 3% since Donald Trump won in the US presidency presidential elections in November, which of course sent the dollar soaring. So a weaker currency means more inflation because of imported inflation via higher payouts, for example, of oil, of which we import more than 80% of our requirements. In such a situation, there is a point of view that India should not be lowering interest rates or cutting them at this point, as we are hoping to next month. The central bank is also expected to use foreign exchange reserves more judiciously as it tries to quell market volatility amidst persistent headwinds, according to Reuters. Oil is still on the boil. And now our energy segment, brought to you by the India Energy Week. Oil prices rose slightly on Wednesday as the market tried to gauge the extent of supply disruptions from sanctions on Russian tankers. That's more than 183 that we've spoken of. Brent crude futures rose about 30 cents to $80.20 a barrel on Wednesday morning. As we discussed on the core report on Wednesday as well, the latest bombshell, like US sanctions on Russian oil, could disrupt oil supply and disrupt distribution significantly, according to the International Energy Agency, which also said in its monthly oil market report on Wednesday that the full impact on the oil market and on access to Russian supply is uncertain. A fresh round of sanctions angst seems to be supporting prices, along with the prospect of a weekly US stockpile draw, analysts told Reuters. On ground, tankers carrying Russian crude appear to be struggling to offload their cargoes around the world, according to analysts. Now, taking a step back, the International Energy Agency has said that it has trimmed its outlook for global demand in 2025 to about 104 million barrels per day, while expecting supply of oil and liquid fuel to average around 104 million barrels per day. So the difference is only about 0.3. So demand of 104.1 million barrels and supply of 104.4 million barrels per day. The agency also predicted that crude could drop about 8% to average $74 a barrel in 2025 and further drop to $66 a barrel in 2026. So now these are the important figures to hold on to, particularly from an Indian economy point of view. Elsewhere, energy and geopolitics continue to be linked as always. BP, erstwhile British Petroleum, and the Iraqi government have agreed to a majority of commercial terms towards reviving Iraq's Kirkuk oil field on Tuesday, according to Bloomberg. BP brass has signed off on those terms with the Iraqi Prime Minister in London on Tuesday. A spokesperson from BP said the teams will now work to define the remaining detail ahead of a fully termed agreement this year. BP is scheduled to provide a company-wide strategy update next month, and its Iraq plans are expected to be a key to the company's upstream future. Kirkuk is estimated to have around 9 billion barrels of recoverable oils remaining. I repeat, it's 9 billion barrels. BP's presence in Iraq dates back a century, and it originally helped discover Kirkuk in the 1920s, and they produce oil from the Rumaila field, according to Bloomberg. This segment was supported by India Energy Week 2025, scheduled from February 11th to 14th, 2025 in New Delhi, and you can register for the same using the link in the show notes below. Are Indian promoters overpaying themselves? A study of remuneration resolutions for promoters of Indian companies by the Institutional Investor Advisory Services Company, or IIAS, based in Mumbai, of 893 remuneration resolutions for promoters presented between 2023 and 2024 showed that only 10 resolutions were rejected over these 21 months. A remuneration resolution quite logically means permission being sought from shareholders to award or increase salaries for the promoters of a company, in this case, listed companies. So the twist is this: if these resolutions had been subject to a majority of minority votes, an additional 216 resolutions, or almost 25% of the total, would have been rejected, according to the IIAS. This would suggest that investors are concerned and remain concerned about the absolute levels of compensation, structuring, and the adequacy of disclosures in resolutions on promoter pay, which also means that promoters control a majority of shares, as is the tradition, and are thus in a position to pass resolutions in their favor, which may or may not be something that minority shareholders want or desire. IIAS also says that the involvement of some promoters as members of the Nomination and Remuneration Committee further heightens the conflict of interest, and says that regulators must mandate majority of minority voting on promoter remuneration and set minimum disclosure requirements while seeking shareholder approval. Trade deficits narrow. India posted a narrower than expected merchandise trade deficit in December at about $22 billion on Wednesday, even as import figures for April to November were reduced following a miscalculation in gold shipments in November. Economists had expected the December trade deficit to be around $27 billion, according to a Reuters poll. Merchandise exports stood at about $38 billion in December, while imports stood at about $59.9 or close to $60 billion in the same month. In December, India imported about $4.7 billion worth of gold and about $15 billion worth of oil. India's Commerce Ministry is yet to release the revised figures for November, which had overcounted gold imports by about $5 billion, which obviously skewed all trade figures, including imports. A big bond issue. And some corporate finance news. Mining major Vedanta Resources has raised about $1.1 billion through a new bond offering to prepay existing liabilities, the company said in a Singapore exchange filing reported by media here. Vedanta Resources has raised about $3.1 billion in dollar bonds in September 24, though the company had deferred this bond issuance following volatility in the market after the US Justice Department in a report charged the Adani Group with bribery. The Vedanta dollar bond was to be priced in November. So the latest bond issuance, consisting of two tranches, a 550 million tranche of 5.5 years tenor at 9.4% and another 550 million tranche of 8.25 years tenor at 9.8% interest rates. Will the budget reduce taxes? Now, there is no doubt that the government has to be liberal on taxes in the coming union budget on February 1st, particularly if it has to increase purchasing power in the hands of the middle class, which has been facing income stress and rising inflation. Uday Ved, partner tax services at KNAV CPA in India and former KPMG veteran, says the expectations on the finance minister are high, not just for reducing taxes on individuals, but for boosting manufacturing and thus creating jobs. He argues that the highest slab of 30% tax should be now beyond the taxable income of 50 lakh rupees per year, which will lead to increased disposable income and also increased consumption in an economy that's seeing a slowdown. I reached out to him and began by asking him to describe how the manufacturing sector could benefit from a tax boost and what that specifically could be.
The Union Budget 2025-26. This is the first full year of the budget after the elections were over last year, right? And the government now has full 4 or 5 years term together to make an impact. India traditionally has been a service-driven economy, and last 8 or 10 years giving more focus on the manufacturing. Very, very important to make India a manufacturing hub in terms of what's happening globally. And India can only benefit from that. So, if one looks at it in 2019, the tax rate, corporate tax rate for the new manufacturing units was reduced from 25 to 15%, with surcharge about 17%. And there was always a sunset or a deadline by which you should start manufacturing. And last year, exactly this time, it was, of course, interim budget just before the election. When we are talking, the deadline was to start manufacturing by March 31, 2024 at that point of time. If you want to avail that concessional rate of 15% or 17% with surcharge. And it didn't get naturally no change in the interim budget. Nobody was expecting it, but certainly there was some expectation when the new government took over, and on July 23rd, 2024, we had a budget. We didn't get that extension. So as it stands today, only if one had started manufacturing by last year, March 31, 2024, then that concessional rate of 15% is available. I would believe that there is clearly an ask in this budget to extend that manufacturing deadline, because a lot of people would have put in manufacturing plants, started doing it. There's always asked, are Indian corporates, promoters investing in capital intensive new manufacturing units? They already started it, but they may not have completed rather the production by March 31, 2024. Certainly it would be an ask not to change the rate. The rate would be 15% is okay, absolutely fine, very competitive globally, but certainly extend the deadline to not only March 31, 2025, because there will be only 3 months left, but possibly extend it up to March 31, 2026. I think that would be the first ask. And that's very easy because that will really give boost to the manufacturing. And coupled with PLI scheme, which has been successful in few sectors, it will help a lot in terms of, people trying to put the projects completing and new projects also to be put into place. I think that would be the first task which will give boost to manufacturing, as you rightly maybe put in that it also creates a lot of job creation because of the manufacturing. There is also an associated provision in the law, which is more theoretical in my mind, to say that if you increase the job by an X number of people, then on additional you get 30% under 80 JJA of the additional cost that was incurred. Now that is more theoretical. Make it more practical to achieve that. So coupled with the manufacturing, job creation and incentive related to that may be introduced in this budget.
Right. Okay. So let me pick up on a couple of tax administration issues now. So linked to all of this, obviously, is the fact that most entrepreneurs, businesses, industries would want more efficient tax administration. And there are several aspects which are top of mind, including around litigation. What are your key asks there?
So clearly there is something called views. I said it for many, many years, something called policy and something called implementation or administration. It's always the gap in implementation. Things have improved a lot, but still there is a lot which can be done. What investors want is a certainty. Certainly foreign investors who want to invest in India, foreign capital is quite welcome. They want certainty more than the reduction in tax rate sometimes, many times I would say. And in that situation, there are a couple of things which can be done. This is not a new ask, an extension of what's going on for last few years, an ongoing thing. But like last year's budget did some rationalization on the capital gains tax. Now this time it could be a TDS, the tax deducted as source, which is really quite a painful process, particularly for the resident corporate taxpayers. When one resident pays to another, I think the tax liability is always determined, right? And TDS has been used more as a advanced tax collection more than the mechanism. So TDS rationalization should be on the top priority. Maybe there are so many 25, 30 kind of provisions or more than that, which are different rates. And that can be just rationalized to make it one for the salary, which is okay, which is going on based on the compensation received, but all other TDS payments like technical fees, professional fees, contractors, that can be just one rate. And which has been the ask by many people. It's not a new ask by me. Like say 5% rate should be done. And within that, even within resident, there is no sense for having TDS, I would say. Okay, only for the non-resident, you try and keep it because the money is going out of the country. And one more part, I would say, there is also TDS in certain situations, there is TCS on e-commerce transactions. That has really not served any purpose, and tracking has been there with other laws. So TDS and TCS should not exist together. 194R is another provision which has created so much furor in last 2 or 3 years since it was introduced, right? That the free perquisite or concessional perquisite which has been given to directors and promoters. Then FAQs which have created more confusion and problem. So TDS and TCS you clearly don't need it in my view. TDS should be one rate, I would say. That really will help rationalization. It will add to a less compliances, which is the need of the hour today. And I don't think there is going to be any, in terms of the tax collection, is going to be impacted. Because corporates will always pay the tax with or without TDS.
Right. Let's come to the common man. And you're arguing for higher exemption limit. And do you feel that's more from an administration point of view or more in terms of putting more, let's say, purchasing power in the hands of people?
No, clearly putting more money in the hands of a common man, the salaried class, the SME businessman, and everyone, I would say. The tax rate, I think the new tax regime which has been introduced is working well, I would say. But there are 8 crore filers today. There are hardly 1.5 crore people who are paying tax. More than 1 crore will be even less than a lakh of people, I would say. Very less. So more in terms of extending the slab rates may be a better way of putting more money. Like 30% slab rate comes at 15 lakhs or something like that. Make it, maybe 25 lakhs, or I would say 50 lakhs. But that would really put more money in the hands of common men, professionals, SME businessmen. Average 15 to 20% tax rate in the hands of individual is a good rate. And collect it, which you have been doing it from high net worth individuals. You have a tax rate all the way going up to 39%. Collect it from there. That is one ask, putting more money. And second, which is across everything, we have basic rate, which is 10, 20, 30, or even for corporate 22. And then there is surcharge. Now that surcharge, honestly, the whole objective of surcharge is to be introduced in some emergency situation where there is a natural calamity or something. It started some very few decades back, and that has become part of the tax. So if you say, what is the tax rate? 30%. No, tax rate, even the highest rate is not 30. It goes all the way up to 39 with surcharge, which is, I think, very high. And I would believe that surcharge should be removed totally. Again, this has been the ask. to what extent it is feasible from a collection perspective, one has to see. Last point I will make it that if you are in a treaty situation, because treaty puts a rate on that's more for corporates. When say a payment for royalty or FTS, fish for technical services made, say the tax rate is 15%, there is no surcharge there. When you're making a payment to a non-resident or treaty situation, why do we need surcharge? Just remove surcharge, I would believe so. I think that certainty would add money to the common man. Then in addition, there could be other asks in terms of give some deduction for the housing, that will interest deduction, which has been there for a number of years, even in the new regime. So I think those are some of the things, but slave rate expansion would be, I think, one of the key asks, which will really add money into the common man. Most of the money is going to be spent in the economy. It will come back.
Right. Uday, thank you so much for joining me.
Yeah, my pleasure. Always a pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.